Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Understanding CDOs, a guide to risks, returns, and market impact. How do financial markets grow so quickly? The answer often lies in complex financial instruments like collateralized debt obligations, or CDOs. Born in the 1980s, CDOs bundle various forms of debt, like loans and bonds, into a single investment. They promise high returns by spreading risk, attracting many investors. But with high reward comes risk, as seen in the 2008 financial crisis, when CDOs played a huge role in the collapse. Understanding CDOs isn't just for Wall Street, it's crucial for anyone interested in how markets tick and what went wrong when they didn't. Let's explore their structure, purpose, and why they matter today. Understanding collateralized debt obligations. Collateralized debt obligations, CDOs, might sound like a mouthful, but they're key to modern finance. At their core, CDOs take different debts and bundle them into a single package. This mix of loans, bonds, and other assets is then sold to investors. The goal? To spread risk while offering the chance for high returns. What are CDOs? CDOs are like a financial smoothie. They mix different kinds of debt, think mortgages, car loans, or corporate bonds. Once blended, this mixture is sliced into pieces and sold to investors. Here's the catch: each slice, or tranche, carries a different risk level. Like a layered cake, some tranches are safer and get paid first, while others are riskier but offer higher rewards. Investors love CDOs for their blend of risk and return. By pooling many debts, they aim to minimize losses from any single debt going bad. But as the 2008 crisis showed, things can go wrong if the debts inside the CDO aren't as safe as they seem. Key components of CDOs. To understand CDOs, let's break down their parts. Each piece plays a role in how these complex financial instruments work. Tranches. These are slices of the CDO, ranked by risk. Senior tranches are safer and paid first, while junior tranches absorb potential losses but offer higher returns. Collateral. This is the debt pool backing the CDO. It includes loans and bonds that generate cash flow by paying interest. Special Purpose Vehicle, SPV. An SPV is a company created just to hold the CDO's assets. It isolates the financial risk, acting like a firewall so the CDO's performance doesn't affect the larger company. Understanding these components helps investors gauge the value and risk of a CDO. Each piece influences the potential return and stability of the investment. And while they can offer juicy returns, it's crucial to know what you're really buying into. Types of collateralized debt obligations. Collateralized debt obligations, CDOs, come in various shapes and sizes. They offer investors distinct choices, each with its own risk and structure. Let's dive into these types to get a clearer picture of how they differ and relate to other financial instruments. Cash flow CDOs versus synthetic CDOs. Cash flow CDOs and synthetic CDOs represent two main types of CDOs, each with its unique approach. Cash flow CDOs. These rely on the actual cash flows from the underlying assets. Think of mortgage payments or interest from bonds. As the debts are repaid, the cash flows through to investors according to the priority of the tranches. Risk. The key risk here is tied to the default risk of the assets. If many borrowers fail to pay, the returns dwindle. Synthetic CDOs. Unlike their cash flow counterparts, these don't own the actual debt assets. Instead, they use credit default swaps, CDs, to gain exposure. It's almost like betting on the performance of the debts without owning them. Risk. While they might seem less risky because they don't own the actual debt, synthetic CDOs carry significant counterparty risk. If those backing the swaps can't pay, investors face losses. Understanding the difference between these types is critical. Cash flow CDOs deal with actual assets, while synthetic CDOs are more about financial betting. Asset-backed securities versus CDOs. At first glance, asset-backed securities, ABS, and CDOs might seem quite similar. Both involve pooling debts. However, there are key differences. Asset-backed securities, ABS. These are investments backed by tangible assets like car loans or credit card debt. Each ABS typically focuses on a single asset type or category. Structure. ABS have a straightforward structure. They pool similar assets and the returns depend directly on the performance of these assets. CDOs. CDOs, while backed by assets too, mix a variety of debt types. They bundle everything from loans to bonds, creating a more complex structure. Relationship. Every CDO is technically a type of asset-backed security, but the reverse doesn't hold true. CDOs involve more varied and mixed asset pools compared to specialized ABS. This distinction matters to investors. While both offer ways to spread risk, the complexity and mixed nature of CDOs make them distinct from traditional ABS. Understanding these nuances helps in making informed investment decisions. The CDO market and its players. The CDO market is a bustling ecosystem filled with various key players. These participants keep the wheels turning, each playing a specific role. Understanding who operates in this market and why they do so is crucial for grasping the mechanics behind CDOs. Let's check out the primary participants in this financial environment. Institutional investors. Institutional investors play a significant role in the CDO market. These are typically large entities like pension funds, insurance companies, hedge funds, and mutual funds. But why are they drawn to invest in CDOs? Diversification. CDOs offer a way to diversify investment portfolios. By pooling different types of debt, they spread risks across various sectors. This helps investors avoid putting all their eggs in one basket. Potential returns. The tranches of CDOs promise varying levels of risk and reward. For those willing to take on higher risk, the potential returns can be substantial. This appeals to investors looking to enhance their gains. Customizable risk. Different tranches appeal to different appetites for risk. Senior tranches offer stability, while junior ones promise higher yields. This flexibility attracts institutions that have specific risk-return thresholds. In essence, institutional investors find CDOs appealing because they align with their strategic objectives. The mix of risk management and potential high returns makes them a staple in many investment portfolios. Financial institutions' role. Financial institutions are at the heart of the CDO creation and distribution process. These entities, primarily banks and investment firms, are pivotal players in orchestrating how CDOs come to life and reach investors. Creation. Banks bundle various debts into CDOs. They assess the creditworthiness of these debts and structure them into tranches. This step involves selecting diverse debts to form a compelling investment package. Issuance. After creating CDOs, banks issue them through special purpose vehicles, SPVs. These SPVs serve as intermediaries that hold the CDO assets, providing a layer of security and isolation from the bank's regular activities. Marketing and sale. Finally, banks and financial institutions market CDOs to potential investors. They use their expertise to highlight the benefits and potential returns to institutional investors, making them appealing investment options. These institutions are not just creators but also marketers and sellers of CDOs. Their involvement is crucial in shaping how CDOs are perceived and utilized in the broader market. The mechanics of CDOs. Collateralized debt obligations, CDOs, are complex yet fascinating financial instruments. They turn various debts into marketable securities. To fully appreciate how they operate, we'll explore two main aspects: tranching and the CDO creation process. Tranching explained. Imagine a ladder where each step offers a different view. In the world of CDOs, the rungs of that ladder are called tranches. Each tranche has unique risk and return characteristics. Here's how it breaks down. Senior tranches. These top-level tranches are like the sturdy first step on a ladder. They are the safest and get repaid first. Consequently, they offer lower returns but carry less risk. Senior tranches are ideal for investors seeking stability. Subordinate tranches. Lower down the ladder, these tranches are riskier. Think of them as being on the second or third step. They are paid after senior tranches. Because of the increased risk, they promise higher returns. Investors willing to take a chance find them attractive. Why use tranching? It allows investors to choose based on their risk appetite. It's like picking the right rung to climb for your particular view of the market. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.